Welcome back to Optimum Live, episode 21 we're at now, and this is about how much can you earn tax-free. Slightly tongue-in-cheek, but it really is a useful exercise to see how we can be as efficient as possible. I think that's the biggest introduction I can give this. We're all going to be interested, so stay tuned. So welcome back to episode 21 of Optimum Live. We've got Mike Blake in here. Hello, mate.
How you doing, Chris? All right?
It had to be you to be crunching these figures. You do this in your sleep, frankly, don't you?
Yep. Yeah, that's it. see numbers all the time.
I think it was summed up by the fact that I've got a load of notes, and I said, have you got notes? And you went, no. I went, how do you know?
Yeah, it's all up there.
Yeah, as I then jokingly said, that's why you don't go to dinner parties then. But this, I mean, there is a degree of this episode being, slightly tongue-in-cheek, having a bit of fun with it. But there is a very serious point to this. It is not how to fiddle anything. It is totally above board, but how we can get ourselves to the most, is it right to say tax efficient way?
Yeah, it's all the little tax-free allowances and everything like that you could essentially shape your earnings to be, but it obviously is quite complicated, which is the tongue-in-cheek way of doing it, to maximise all of them. But someone will be sat there looking at it going, oh, I didn't actually know about that one. That's quite interesting. And it might be suddenly they could earn a little bit extra money knowing that they haven't got to pay the tax on it, so it makes it worthwhile.
So you're basically becoming our Martin Lewis today, then?
yeah, if you want to put it that way, yeah.
We better not, because we'll get sued. Sorry, Martin. We don't mean that. But it is, like you say, it's complicated. I've had a look through and my head's blown already, but it's about making sure we're there. Okay, where do we start? I'm going to work through the list that you had in the bullet points. Yep. First one, personal allowance.
Yep, so this is the one everyone knows about. £12,570 you can earn
as of 2025.
Yeah, this current year. It might change in a budget, you never know.
Never know.
But yeah, that's how much any individual can earn tax free. High earners, that amount goes down, but we're not talking about those ones at this point. We're just as a typical individual, you can earn that amount tax free.
Okay.
And that covers your employment income, pension income, rental income, anything like that. That's 12,570 of any earned income.
So it's not just, because I know we get into like salary and dividends and all that. It is actually from everything.
So you could have 12,000 of dividends, 12,000 of salary, or one of those, or some self-employed income, or a mixture of all of it, but 12,000 is tax-free.
Together.
Yeah.
Right. I got you. Okay. And that is all that kind of, I get the impression when working with you guys is that that's the foundation that we then work everything else out thereafter.
Yeah.
Of the most efficient.
So if you've got a limited company and you work for that limited company, the company itself doesn't have a tax-free allowance. So if you don't put a salary through, then you're potentially wasting your tax-free earnings. So you could earn 12.5 grand, okay, which is a couple of grand of tax, 2.5 grand of tax that you could have saved in the company. So that's where sort of the basis of starts. And it also interacts with the likes of national insurance and stuff like that.
Yes.
And getting your state pension stamps, the salaries. But essentially you could earn 12 grand, 12,570 tax free.
And so in other words is that if I had, I don't know, and I know I'm going to use an example that I shouldn't because I know we come on to this in its own right, but let's say I've got a rental property or something like that that's given me arbitrary figures, £6,000. I would then only pay 6,570 of salary would be tax free.
Yeah.
Yeah. So it's 12.5. Got you. Okay. That's straightforward. Next one. And I don't think I've heard of this one, trading allowance.
Yeah, so this one, we did a blog on it a while back when everyone got, it would come out in the news about HMRC cracking down on all your side hustles, essentially.
Yeah.
Okay, so the idea of that, it was working out, so those people are selling stuff on maybe Vinted or eBay and stuff like that, right? So essentially, if you receive £1,000 a year from these side hustles, whether that could be casual, like doing a few shifts in a pub, doing a paper round, or you name, like something that earned the first £1,000 would be tax free.
Okay.
So you can either, so say you received £2,000 from these side hustles that was taxable side hustles. You could either offset your expenses, which could be a bit of travel, bit of this, bit of that. Okay. Or you can take the first £1,000 off and just treat it as your income. So you ignore all your expenses. You don't account for any expenses. You have the income that comes in, take £1,000 off, and then the rest is taxable.
Okay.
So if we were doing it for this episode, we'd be going, you could earn £1,000 on the nose for no tax, and that'll be covered by your trading allowance.
Fine. So now I can get paid a salary. Let's go with easy figures, as daft as some of it might be. I can earn a salary of 12,570.
Yep.
No tax. I can go
get a paper round and earn £1,000 a year.
Yeah, absolutely. That's a good paper round.
Yeah. Or it's a lot of papers.
Well, there is that. Yeah, exactly. So now we've got 13,570. So that doesn't come off of this 12.5.
No, it's another one. Yeah.
Might not be a conversation for this episode, but where on earth is that logged? I mean, if I've gone and you use an example selling some stuff on Vinted or whatever, I mean, I guess the point being is there is a paper, we call it a paper trail, an electronic trail somewhere.
Everyone's taxes is self-assessed. So it's you telling HMRC. So if you earn £2,000 of that income, you would need to declare the £1,000.
And I guess the point being is that that's above and beyond now. Presumably it's not like, I don't know, let's say I've got a roof tent that's £2,000. I've sold it for £2,000 because I'm not using it anymore. That's not a side hustle, surely. I've bought that and I'm now selling it.
So, but if you were selling 10 a year, because you're buying and selling them.
Yes.
The reason you're doing that, it's called badges of trade. You would be looking to make income off of that. Whereas if you're selling your own stuff, so that's what people got worried about,
selling my
because
own stuff.
it was like, they were like the
cottage, because that cottage industry, I think.
Yeah, parents were selling their kids' clothes and stuff because they were still able to be. That itself isn't. You bought it for more, you sold it for less, you've used it for yourself, you're just moving it on. That's not taxable income. So none of that applies.
Got you.
Because it's not actually there it's not an income. However, going and cutting someone's lawn once a week or something like that, and you get paid a tenner for, that would all be part of this. Because your view is to make money.
Yeah, and making garden ornaments out of empty beer bottles or whatever.
And selling
and then selling it. That is you're being creative, whatever. I get it. And my roof box example is that if I found a way I can buy them for £1,000 each, and I'm now selling for £2,000, I'm making £1,000 a pop.
Yeah, and your view of the reason for doing it is to make money.
Yes, I got you.
Whereas the reason for selling like your kids' clothes is to move them on.
Exactly.
Because they've outgrown them, you don't need them.
Got you.
It's not actually, no one's, apart from my wife for her business, she's not buying the clothes to sell for a profit. You're just buying them to clothe the kids, and then hopefully there's something worth it at the end because they go out of them so quick.
Yeah, better than throwing them away and all of that. That makes sense. Now I think we're about to get a bit more complicated and detailed. Property allowance.
So this one is, so there's two to do with property. There's renter room relief, which we'll do next. And then we've got this one, which is a property allowance. So you can earn £1,000 off of your property, tax free, right?
That doesn't sound a lot.
No, but we're not talking, so most people
in a year, because that's in a year.
Yeah. And most people will be looking at that going, well, I can't rent my house out for that much, right? It's not about that. It's thinking of it in a different way. You could rent a parking space on your drive. So if you rent that out, say you rented it for £500 a month, whatever, like if you're in London, right? Then that would actually be taxable income, because there's a source of income. So you can earn £1,000 of renting, say, a car parking space. Maybe you've got a large garden that you rented it out for a wedding. Yeah. Right? It's bits like that. So the £1,000 there could be tax free. So that could be, renting a parking space is a typical one. Yeah. That's aimed at.
Okay.
Maybe you do it on match day. You live near a football stadium and you do it on match day and you rent it out for a tenner, 15 quid every home game. Yeah. Technically, that's taxable profit, unless it's covered by this £1,000.
Yeah, if it's within that, then you don't. And you do, I think there was a note somewhere that said if it's below it, you don't even need to declare it, do you?
No, that's it, because it's covered by that tax-free allowance. So the aim of some of these allowances is to take people out of self-assessment that don't pay tax, that don't need to be paying tax. So these little ones on the edge, because actually it costs the taxpayer more money to have those people declaring essentially nil returns.
Yeah, and it's not necessary.
Yeah. So it's to take out those and reduce the administrative burden on HMRC and the taxpayer.
Oh, that makes sense. Okay, that's cool. Do we now bring up the rent?
Yeah, the rent a room kind of goes quite, because the two sort of overlap, but they're not allowed to overlap. So you can rent a room out, typically seen as a lodger. You rent out a room in your own house that you're living in, so a shared space in your house, and you can earn £7,500 a year that's tax free. So that's quite a bit of money for a lodger.
Yeah.
So essentially the idea is to help create space for other people to live. So if they enabled it for you to be tax free, as incentive for you to take on a lodger that might be helping out the housing stock, because there's less people pushing for a house or so because they can just rent a room.
And the probability is if someone's renting out one of their rooms, they're in a situation that has also said we kind of need to
help out pay the bills.
Yeah.
So
it really does incentivize them. I get
the idea.
Because initially my response was, hang on, so $7,500 for renting out a room, but only £1,000 for a property.
Yeah. But then if you go, rented the room relief and rented a the driveway.
Yeah.
That's 8.5.
But I know you use an example of a driveway, and another one could be actually garages. People rent out garages, don't they? But because it's called property allowance, I assume that also include if I was just renting out a house.
Yeah. So
I only get £1,000 tax free.
Yeah. So
if I rent a room, I get £7,500 tax free.
Yes, because you're not living in the house. If you rent the house out, typically, if you got a buy to let, you're renting the whole house, you're not living there.
Yeah.
So you could get £1,000 off of that tax free, but typically your expenses are going to be higher.
Yeah.
So you want to take that approach and work out your profit rather than just taking £1,000 off the income coming in. Whereas if you're renting your room out in your house, you're still living there.
Yes.
So that's your house. So therefore you get a bigger allowance because it's creating an extra space essentially for the accommodation rather than another rental property that could be on the housing market to be bought or sold.
I bet a lot of people overlook that one.
Yeah, and I think some people, you see it quite often when couples divorce and one moves out and someone's left with the house.
Or kids grow up and move out.
And so they got a bigger house and maybe can't quite afford to keep all the bills paid for. It's getting a little bit tighter. So actually, if they got a 4-bed house, they rent one room out for £600 a month. People do it. We're doing it in Malmesbury because of like Dyson students will come up, or people will come up and work at Dyson, and they'd rent a room for the week. Go right, well, pay for the month, but I'm only there Monday night to Thursday night, and then they go back to wherever for the weekend, and they just come here for work. There's a lots of those situations. Now, this rent a room doesn't cover if you got an annex, because that's not part of the house. That's separate to the house. So it's got to, it's got to be part of your house. Because otherwise it could be classed as like renting a buy to let.
Yeah.
So it's got to be part of the house.
I'm almost envisaging you next turn around saying, and it doesn't count if they've got an ensuite because that's too self-contained.
No, that's okay. As long as they haven't got their own separate door that's not. So if you have, say the annex is literally connected to the house, but they have their own separate door and you can't access it from the other side of the house.
Yeah.
That's like you would compare it to like a semi-detached. That's a separate place. You couldn't get rent a room.
But if it was an extension that you've built on somewhere along the line and there is that you access.
And it's communal and it's coming and going and essentially from the existing house to where they are is all part of the same house. You can all interlink between. Then that's okay.
That's okay.
But it's when it becomes like a hard wall and it's locked door and it's behind a cabinet or it's something.
Presumably they can have a lock on their bedroom door though.
Yeah, that's okay.
That doesn't
as long as like essentially they're using the communal areas, the kitchen, the bathrooms and stuff, or like typically the kitchens. So like you come and go together as if they're living like one of your children there. So you see them up rarely, but they are there.
I've been told she's still there. Yeah. She occasionally shows up with a grunt. Fair enough.
Clip that one.
Yeah. Get me in trouble. That'll be done. So your point is lodgers. Airbnb in the home as well. That applies to as well.
Yeah, that's it.
So that is, you get some weird and wonderfuls on Airbnb, and it could be that, yes, it's a house, but you're able to rent a room.
I've done that when I've done, back in the day when I was more, physical, or more fit. I, did the Bournemouth Marathon, and I'd done an Airbnb and stayed in someone's house. There was a spare room in the house, just so I could kip and then go to the race.
Well, occasionally I kind of go that route where obviously I'm commentating all over the place, and instead of a hotel, it's like just grab an Airbnb and it's fine. You
just share the house essentially, so get
$7,500 tax free.
Yeah. So it's ways where things get a bit tighter. There's ways of, if you want to, earning this extra money that hopefully helps cover the bills.
Just sort of like checking a couple of the key points here. It says under the rent a room relief. Is that really what it's called?
Rent a room. Rent a room relief, yeah.
You can't deduct expenses if you claim this.
Yeah, so it is purely done. All these allowances take off the money that comes in, so ignore the expenses. So if someone rented a room out from your house and you were living there and they paid you £1,000, so 12 grand a year, okay, you would take the 7.5, if you wanted to use the rent a room relief, you would take the 7.5 grand off of the money, 12 grand coming in.
Yeah.
Okay. And then you just be taxed on the 4.5 grand.
As in that goes into your self-assessment that you've earned that as well. Yeah.
Whereas you could, if you wanted to, take the 12 grand coming in and offset the expenses. But typically in your own house, the expenses are going to be very minimal.
Yeah.
So you're going to want to go for the 7.5, and you can't interlink the £1,000 that we talked about, like the property allowance for renting a driveway, as well as the 7.5 on the same income source. If it was separate income sources, then yes, that's fine. You can use both of them, but you can't use them on the same income source.
Okay. Again, this is probably one of those areas that it is always worth speaking to you guys.
Yeah. And it's just like so some people who have a part-time job, in theory, could earn 12 grand on employment income. They could rent a driveway for 1,000. They could rent a room for 625 a month. And have that level of income if they do it that way.
Yeah.
Obviously, it takes time to plan it, but it's possible, which is what this is about. It's just what things are possible out there.
Now, an interesting point I see here, you can only have one of these two, rent a room or the property allowance. You can't have
on the
both.
Same income source. So if you rented the drive to Mr. Smith,
yeah,
and you had Bob that was renting your room, that's fine, because that's two different income sources, two different allowances.
Got you. But it couldn't be the same person doing both.
No.
And have the two different
that's
allowances.
It's got to be separate.
Fine. I get that. That makes sense. And you've got to use both reliefs in the same tax year if they're separate income sources.
Yeah. That's getting into the detail.
Yeah. We'll let that one go. That's fine. Yeah, so, okay, rent a room relief 7.5. Okay, they make sense. I get those now. I thought that was going to be more complicated than it was. So
no, it's just, that's it. All these are aimed at just sort of things that people might have been doing. And it's just kind of taking some of those out of the tax system, because actually they're not generating any benefit for the taxpayer. They're actually probably costing money.
Okay.
So taking those ones out. But the rent a room relief, because that was 5,000 a few years back, they put it to 7.5. So the idea is to promote sort of people where they got a spare room. Okay, someone could rent that room rather than trying to take on a whole flat themselves. More affordable for them.
Another way of helping the housing crisis.
Yeah,
basically.
a little bit. It's just a little one. And to be fair, I've got a few clients who do it, and actually it helps out a bit. They're able to earn some extra money, and they're on their own. If someone else around the house, it's okay.
A potential erroneous question now, and not for the first time, as I know you'll say, is. So I'm renting it out for, what did you say, £625 a month.
If I've got that right.
Well, I trust you. Everyone else is doing crunching the maths now. But if they then contribute to bills, I don't know if that's even a thing.
No, it's a good. Actually, that's a fair question. I'll let you have that one. I felt the room get lighter as you went, I've got a question. That includes everything.
Fine.
So all the money that comes in. So yeah, you couldn't go that's £625 for the room, but I want 50 quid for the broadband, 100 quid for that. It's all part of one payment. Because if you start trying to offset it and want to offset it, you want to be bringing in the expense.
Which I'm assuming, out of simplicity, you'd want both sides would want just an all-inclusive figure anyway.
One bill, yeah.
Yeah, exactly. Yeah. So, okay, I did ask a good question. Make a note of this. I think I'll
store that one.
Yeah, exactly.
Stick that one on the wall.
It can be done. Next one, because I think we've done those enough, haven't we? Yeah. Dividend allowance. Mm-hmm. Now, this figure, £500, seems ridiculously low.
Yeah, it used to be £5,000.
No.
Yeah, it's been coming down over the years. Yeah. So it was £5,000. So everyone could earn £5,000 of dividends tax-free.
Right.
And then the rate of dividends has been going up, and the amount you earn tax-free has been going down. So, this usual thing, same with the national insurance, gets more expensive and it starts quicker. So the idea being with £500 is where people have got these little investments along the way, maybe a couple of Tesco shares, a Shell share once upon a time, an Empower one, like anything like that, where they've just acquired a few shares, maybe from their parents or something like that along the way, and they get 20 quid here, 30 quid there. Nothing major. There's no GSK shares that are kicking out a load of money, like just little ones.
Yeah.
Essentially, those people earning 500 quid won't have to do a tax return for that. So again, taking those really, really small earners that might pay like, what would that be? 40 quid of tax on those if it wasn't tax free out of the tax system.
Yeah, because again, it's not worth the effort.
So obviously they decided that £5,000 was a bit too high. They'd have that tax in between. So they brought it down over a few years, but it is £500 now.
Controversial question, I suspect now. Has that been caused by the fact that was the way that everybody ran off to do their earnings, was by dividends rather than selling?
Not really, because actually the number of people that do run it through a limited company compared to people who just have small investment shares is probably quite a lot lower. There'll be more people with little investment portfolio, shares and stuff. So it's not that, it's just another way of just curbing a few more quid back into the pot.
Okay, fair enough.
I don't think coming up that will change, because I think when you look at what it's trying to do, it's just trying to take those few low earners out of the tax return system. Yeah. So it won't go down to zero, in my view. It would just be, it will just stay as it is, and it will just cover those sort of ones.
Sort of removing the admin costs, basically, isn't it?
Exactly that.
Okay. So but it's still another £500 tax-free that we can have there. Next one, savings allowance.
Yeah. So this one...
Can I just double check on this, and excuse my ignorance, because I've got two bullet points here. One called savings allowance and one called starting rate for savings. Are they two different discussions?
Yes. So if you're a basic rate taxpayer, so your income's below £50,000, you can earn £1,000 of interest tax-free. That's £500 if you're a higher rate taxpayer. Okay. So, but if you're a low earner, so you have a 12,000 salary, you could actually earn another £5,000 of interest tax-free, then another £1,000 of interest tax-free because you're a basic rate taxpayer. Yeah. So in theory, you could have, in this example, for just looking at these, 12,570 as a salary, £5,000 of interest covered by the starting savings rate, and then £1,000 for the personal savings allowance.
Right.
Getting you to 18,570.
Where are we finding that rate of interest, though?
Well, we don't know how much money we got sat in the bank account.
Well, okay, fair enough. Surely if you've got enough to earn that much interest, you ain't bothered about tax.
Because the interest rates have gone up, someone could be retired, right, with a state pension, earning about £12,000. They could have £100,000 of savings they've accumulated over their lifetime. At 4 or 5%, that's £5,000.
Is it? Okay.
So because the interest rates are higher, now if we roll it back to pre-COVID times, interest rates on your savings was 0.25%, 0.5% at best, right? No one was really seeing this level of interest, whereas nowadays, actually, it can roll up quite quickly. Yeah. So I've just pulled some money out of a mortgage for an extension, I put it into a savings account, and actually, you've got to make sure it's in the right pot and ISAs and stuff, because actually you're earning quite a bit of interest off it that's relative to earnings.
That'll explain why my dad turned to me and said, you guys might be upset the interest rates have gone on up for your mortgage, but we're delighted.
Yeah, that's it.
So when I said, thanks, Dad, I should have meant it because he's got a valid point.
Yeah, because he was earning considerably more.
Yeah, okay.
And that's it. So someone who has, so again, you think of who this would apply to typically is someone who's got to retirement, has got a state pension or her state pension, got some savings because they've been good and they saved some money. They could actually earn £18,000 tax-free, 18,570 tax-free via their savings and their employment. Now, that £5,000 saving allowance does decrease if your income goes up. So if your income say you've got a salary or pension that earns you 15,570.
I heard the word in there.
That would reduce you by £3,000. So you would then only earn £2,000 extra on the savings. So as each pound you go above 12,570, that's £5,000 comes down.
Oh.
So typically, most people won't get that £5,000 salary. Say they're on a minimum wage or something like that, they would be on 25 grand. So you wouldn't get it anyway. So it's looking at those ones with low employment income.
Okay.
Or pension income.
Yeah.
Which dividends, doesn't get included because that's not earned income.
Obviously.
Which is good.
Yeah, it is.
So you can have your small salary.
You've got to remember things like this.
Yeah. You got your small salary. You could have lots of interest, then your dividends, and you still get that interest that's tax-free.
Okay.
So if you've got some money and you've lent it to your company and you're getting interest from your company, it could be a way of getting some of that out that saves tax in the company and earns you income personally. And tax-free.
We've got a couple more yet to cover, but presumably when you guys are working with us as clients, you are by default looking at all of that and are able to kind of move between the pots what's necessary and things.
It's why us here at Optimum, we want to have these meetings.
Yeah. Because
we have the conversations. It's not a direct 20 questions on an email. Have you got money in your bank account? What do you do with this? What about there? What about that? We'll have a conversation and we're gathering information the whole time.
Yes.
And it might be, that's it. So I know what I'm trying to find out in a meeting, but it's more, it's a better relationship if we're finding out as we go along a little bit more casual than going, right, so how much you got in the bank account?
Yeah.
Or why? Well, I need to know that. And it becomes a bit more disjointed. Whereas if we gather up the information, we go, right, actually, based on that, we could look to do some of this with the savings. We could do this with your earnings. We could do a little bit, that little bit of side hustle. Yeah, we could use that, trading allowance. Right. We can work those bits out for you.
Because that's the whole point, is that I know obviously it's called self-assessment, but someone like me, if I was just doing myself, I'd miss half of this.
No, and that's what we're here for. We're here to help you complete your self-assessment. And so we're gathering up those bits of information. And for some people, there is literally nothing we can do. So people always go, I want to move account because I want him to save you tax. I might not be able to because there might not be anything to do.
Or you might not be able to now. And I get the impression that there's times that you can go, if you start thinking about this, that will help you in a year or two.
Yeah, and we can look to change things. But for some people, I looked at someone, I was taking on a potential client a couple of months ago. And I said to him, there's nothing here that I can do that you're not currently doing yourself. However, I'll give you the peace of mind and the comfort to know that it's right, it's accurate, it's done. We've got the deadlines. You don't need to worry about that. We'll just gather it for you. I said, so at that point, because he'd done a really good job of his figures, I was like, I'm just going to give you peace of mind and comfort that it's all good. And you can call me at any point that you got a problem or you've got a question, rather than having to just sit on the internet trying to find it yourself. So for some people, I'm not going to be able to save them tax.
No.
But for and for those, it's just a comfort. And for other people,
I'd rather know that we're covering all bases.
Yeah, that's it. Cause I was chatting to somebody yesterday and he goes, I've been doing my tax return for years, but I don't know if it's right or not. And I was like, but actually he's mentioned that to me a few times. So it's obviously on his mind that it might not be right. So if I go, no, yep, it's all good, done, then it won't be on his mind that it's not right. And so then he can focus on the rest of it.
Because I always remember Richard Matthews, obviously, who was, the founder of, enjoying his retirement these days. And he used to say, don't chase the dragon. If there's tax to pay, enjoy that you're doing well, that there's tax to pay. Yes, it's about being efficient for sure, but it's not about eliminating it, for goodness sake. Don't chase that dragon.
That's it. It's the same as like with people come and say, I want to pay tax in the company. So, but if you want to be able to earn money to pay the mortgage and bits like that you take out as dividends, that's coming from post-tax money in the company. We talked about it before. So you're going to pay a corporation tax bill there. So there's going to be tax to pay if you want to be able to live and pay the bills and pay the mortgage. And
we can grumble about it all as much as we like. It isn't going anywhere. What do they say? The things you can guarantee is death and tax.
Yeah, that's it. Yeah.
And it is what it is. But, this is a useful exercise to see that, hey, there might be some other bits and pieces. I think we got one more in your equation that you did, capital gains tax allowance.
Yeah. So if you buy some shares in Apple for a tenner, sell them for 20 quid, the profit becomes part of your capital gains tax.
Yeah.
So you can earn now, it used to be loads more. So when I'd done this a few years back, you could, the total of this came to nearly 50 grand. I think with all the different allowances that have come down over the years, whereas now you can only get £3,000. So, the total amount. So, typically financial advisors, if they've got a pot of investments, they'll be doing some little selling and stuff during the year to make sure that they've created your pot an extra £3,000 of tax, like the money you don't have to pay any more tax on.
Yeah.
So they do that. I see it quite often in their tax reports and stuff. They've done some bit of selling, crystallized about some money, and away they go. So there's that you could earn. So if you could buy some shares, sell them before the end of the tax year, put £3,000 of profit in your pocket and not pay any tax.
And then leave the rest still in shares.
And then reinvest again next year and go again.
Okay. Yeah, that makes sense. So that's another three. I got to ask a question then. You're getting nervous that I'm asking so many.
Yeah, I don't
get one right, and that's no stopping me, is it?
It's just how bright the room gets.
I know,
each
it's
time.
Amazing. I'm going to go with your example. Buy Apple shares for £10. Other companies and fruit
that's
are
a bargain,
available.
isn't it?
Yeah, probably. other companies and fruit are available, but buy it for £10. Sell it for £5. They don't do it the other way. That suddenly adds to my allowance because I've lost there, do they?
No, but that loss will carry forward to next year. So yes, in theory it will. So if you've got a load of losses one year,
personally, so
like personal capital gains losses, as long as you sell them and crystallize that loss.
Yeah.
That'll be used. You use it. It gets used first before your allowances next year.
So if I lose, again, just for simplicity, I've lost £1,000 on the shares, but I needed to get out because it was going to go worse.
Yeah.
I've now got £4,000 allowance next year.
Yes. Essentially, yes, that's exactly right. So again, that's something that actually does regularly get missed off, is that people won't tell us that, because to record that loss, we've got to put it on your tax return. So if you don't tell us, we don't put it on. So everyone, again, I'll give you that. That's 2 for 2.
I'm doing well.
That's a really good point, because people remember to give us information that they got to pay tax on, but forget these other ones. So again, a client at the moment, he's got a capital gains, but he's also got a load of losses that he's done, and he's crystallizing some on some shares and stuff to make sure that he can use that.
Yeah.
Because he knows that he's lost money on them.
And I know that some people might go, well, why are you selling them if you're losing? It's like, because if you know that there's about to be a run on this company or something to that effect, or you're seeing it crashing, you're like, quick, get out now so I can, minimize my losses.
Or if it's at the bottom and there's no way it's going up, and you've got a taxable gain, you could lose it to save the tax.
Got you.
Because otherwise, if you pay the tax on the gain now and you sell the ones for a loss in 3 years' time, I can't put that loss back here.
No.
So it's one of those. So again, it's just being aware and being clever and looking forward and just seeing what you can offset.
It's creative, isn't it? That's the reality. So if we add all of those ones that you've put figures on, that now adds up to a total of 31,570.
Yeah.
Tax-free.
Tax-free. legit. No, we haven't talked about that. Like, so you could have an uncapped amount of interest on ISAs.
So that's uncapped interest on ISAs.
Yeah. So if you had £1 million in your ISAs that you've been building up over years, or something, I don't know if it's possible. Maybe.
Yeah.
I don't know. But in theory, right, that interest is all tax free because it's in an ISA.
Right.
And there's also ways of earning money from EIS shares and VCT shares, which goes off in a massive tangent, which that gets serious rather than a sort of like tongue-in-cheek approach. But so if you any money in ISA, so I always panic when I'm talking to a client when I'm finishing off their tax return, because I know clients have got some money in savings, and I'm like, I haven't got it on the tax return, and I go to them and go confirming to them that money is in an ISA. And most clients have got their money set in an ISA. So, but years ago, when I was sort of first starting out into accounts and stuff, the interest rate was so low that I didn't see the point at the time of an ISA, because it was tax free anyway, because you weren't earning very much, or it was because whether it was in a normal savings account. But by adding each year to the ISA, now the interest rate's gone up. 10 years ago, if you put in your 20 grand a year, you got 200 grand. At 4%, that's £8,000 a year, that's tax free. Whereas over here, if you left it in a normal savings account, you'd have £8,000 taxable at 20 or 40%. That could be £3,000 a year.
Jeez.
Every year. So then you go, oh, actually, I wish that back then. And so.
But you can't suddenly move all of that over to an ISA because it's a certain amount a year.
A year, that's it. So that's why your financial advisors will tell you to put money in ISAs, because when the rates start going up, it compounds on itself, and it's very, very nice, and it's tax free.
Now I'm wishing I'd done that.
Yeah. But we all need the money lying around to be able to do it.
Well, there is that. That's my big problem.
So
exactly.
yeah, that's the thing to be aware of as well. It's just people might not realise that's the effect of what it can do. One year you might look at it and go, well, actually the interest off of that, putting 10 grand in my ISA is covered by these savings allowances. So why does it matter? But if you keep adding to it and the balance grows, at some point you're paying tax when you could have not paid tax.
Why is that uncapped tax free? Why have they put?
I don't know.
I love it, but I'm interested that
I suppose it's promoting people another way of saving some money. That's aside. So I suppose the government want people to have savings because they've got their own war chest of things if things go wrong, or in later life if they need care, they got some money in there.
Presumably that cash, I don't know, maybe I'm being cynical, is that they've actually got use of cash that's sat there.
Well, the banks are all using it because these ones aren't. You can put you in the NSI and stuff like that, which would then be government-based ones, but the banks are using it. But it's more, I think it's more just allowing people to build up some funds.
Yeah, okay. Premium bond winnings as well.
Yeah, it's gambling.
Well, of course it is, yeah.
Because it's a form of gambling. Gambling's tax-free. It's why when you see like your national lot, you go and
people still do it. I mean, that's
what, gambling?
No, I know they do that. Crikey. But no, premium bonds. I mean, for me, in my head, that's like an old thing.
So people did them a lot around COVID time.
Okay.
Because the interest rates were low and people were coming into some money.
Yes.
So they put him in there because the interest rate was low. Now the interest rate is higher. I think the appeal for a premium bond is lower because if you add up all your winnings, I think it's less now. It would be less than your interest rate. So but then there's always that chance of that big one.
Yeah.
I don't know who gets it. But then if you do earn, it's tax free because it's the same as gambling.
Okay.
So the same. You could earn a whole load of money if you gamble. Tax free, but you just can't offset all the money you've lost in the meantime as well at the same time, which is why they go, because let's face it, the house wins, so you're going to lose out. So if they tax your winnings, they'd have to allow the losses.
I know, I keep buying those lottery tickets. I'm just funding everyone else on that. And I think that was where we wanted to wrap this one up. We weren't going down, state-related stuff and all that.
No, that's it. So one thing I've put on my way up this morning that I was thinking about. So people look at their personal allowance. They know that's your tax-free. Then they start getting their pension money. And say they got their state pension and they're still earning from their company or from whatever role they're doing. People think that the state pension is tax-free, because you paid into it as the pot. And an important bit I would say for this is just because I had the thought this morning is that state pension is still taxable earnings. For most people, like historically, if they got to their pension age, that was their only earnings. So it was tax free because it was covered by their personal allowance. But where people have got, second pensions, private pensions that they're drawing on, or they're still working, because people do still work nowadays, whilst getting their state pension, it all adds up together. So it does become taxable.
Okay.
It might not be directly taxable, but your other source, so you got from your own company, would then be taxed at 20% because your state pension largely absorbed up your personal allowance.
Got you. In essence, though, there's probably a lot more than we realise that can be leaving more in our pocket.
Yeah.
You know, that's the reality of it. Completely legitimate ways. Adding all of them together is a very hard jigsaw puzzle.
Exactly.
To say the least. But there are some there.
Because at some point you needed to earn the money, to put the money in the savings. Well, you need to pay the corporation tax to enable a dividend allowance.
It got complicated. But, you know, it's about being aware. It kind of emphasises the point again. That's where you guys as experts are better than me trying to do self-assessments and making sure I've got everything and that I've got everything accurate. But it's always about understand, because that picture changes every year for an individual anyway, doesn't it?
Yeah, that's it.
Let alone the government changing things, regularly as well. That means that you've got to keep an eye on it. But it shows there is more possibility out there.
Yeah.
I think that sums it up brilliantly. I don't have as much of a headache as I thought I was going to get from this one. I'm quite relieved. And it does show that our next episode, as it stands, our next episode leads on quite nicely from this, I think, because, and this was quite another tongue-in-cheek title we've gone for, of what does your accountant actually do for you? And I like that one because I've learnt that it's an awful lot more than you think. Your priorities might be different, but it's kind of almost already slightly demonstrated with today's episode why that's going to be a good topic for us to cover.
Absolutely. It might answer some questions that some people have got, and it might give others reassurance that we're doing more than perhaps they thought we were doing.
Yeah.
That's just being checked in the background.
Exactly. No, I love it. Well, I look forward to that then. That'll be episode 22. But for episode 21, I hope it's been useful for you. I hope you don't have a headache either. If in doubt, because I know some of it you'll go, so do I, don't I? Get in touch. optps.co.uk. All of the contact details are on there as well. Get in touch. Fire any questions over that you might have, and the team will be delighted to answer them.
Absolutely.
Fabulous. Well, thank you for joining us. I hope it was useful, and we'll see you next time. Cheers.